Good afternoon, everybody, or good evening, I should say. Hey, welcome to our second quarter capital market review. My apologies for doing this one a bit later than normal. We like to get these things out a couple of weeks right after the end of the quarter, and unfortunately, General Motors offered a large buyout package to a number of retirees, and for about 45 days we were completely swamped with running a series of retirement analyses, so it kind of pushed everything else we were doing on a regular basis back. But thanks so much for attending on this summer evening. A couple of things we're going to talk about today that are a bit different than usual. We usually do these things as kind of a SWOT analysis, and this time around, we're going to do it a little bit different. There are a couple of questions we've had over the last couple of months, clients who've had certain concerns, and we wanted to reference those concerns as topic points for today's discussion. So what we will do is get into that. I always try to start with the theme. And the theme this quarter is the same as the theme last quarter, confusing times. In fact, it was interesting because we talked about how before the end of the year we had a huge amount of pessimism, and as we began the year it was optimism. Right through the first quarter of the year, market values were up nearly 10%. And then second quarter, that kind of spilled back over into pessimism again. So it's a bit confusing. People are certainly keyed into headline and headline risk. Every quarter we do this, and we do this for the same reasons. One, we think the economy matters. We want to dissect the several market components, look at growth and jobs and profits, inflation, interest rates, and see how these things kind of are working today, whether there are some concerns, and more importantly, what this means from an investment or portfolio point of view. What we try to do is attempt to answer, hey, where are we right now, and more importantly, where we're heading. And the idea behind that is by pushing out more information to you, it will help us stay balanced, certainly stay diversified, and more importantly, stay invested. What we don't want to do is succumb to concern and fear and then change allocation or methodology. Usually that has horrible repercussions. The 6 themes that we're going to talk about this quarter are themes that a number of clients have asked questions on, as I said. The first theme is I believe the U.S. expansion certainly has slowed, but it hasn't stalled and probably won't stall into a recession. The fiscal cliff that we hear much about likely will be avoided. Unfortunately, higher taxes, especially for the quote-unquote wealthy, probably won't. Europe is ugly, but as far as we're concerned, it's probably priced accordingly, so no big concern or worry there. Emerging markets are cooling off. Valuations clearly favor equities over fixed income at this point, and have for a number of quarters. And as always, a balanced approach to investing certainly works over the long term. So where are we today as we ended the second quarter? Well, the markets recovered certainly from the lows. In fact, interestingly enough, the market through June 30th was up 101%. Pretty much the same as the recovery from the lows of the dot-com bubble right up to the high of October 9th, 2007. And you can see that we had a pullback during the second quarter and a slight recovery going into June 30th. Along the way, we had a big drop in this recovery during the summer of 2010, and another big drop during the summer of 2011, and here we are, summer of 2012, and we've got a little bit of disturbance as well. Based on sectors, the market was kind of split. We had certain sectors that performed reasonably well and other sectors that did not. When we identify performance for the year, things like financials, technology, things like telecom, and consumer discretionary, things that normally would favor expansion, performed much better than defensive areas like utilities or energy. As we had that sell-off in the second quarter, we noticed that those areas that tended to perform the best also pulled back the most. So year-to-date, financials were up through June nearly 14%, in spite of the fact that they gave back almost 7% in the second quarter. So those areas that performed the best gave up the most. Those that performed the least gave up the least, were more defensive. Valuations, still cheap. PEs right now are about 12.3%. That's forward-looking PE. A year ago they were 12.4, but more importantly, based on long-term average of 16, almost 17, they're very, very cheap. Price to book, very inexpensive at this point. Price to cash flow, also reasonably inexpensive. Anytime you can buy a company at price to sales of 1, that's extremely cheap. Historic average is about 1.5. Current is something closer to 1.2. Fairly inexpensive. And dividend yields are still fairly robust compared to long-term average. When you look at the spread between earnings yield to U.S. investment-grade bond, very wide. And when you see that, that generally bodes well for stock price performance and valuation. When we look at where stocks are today, in spite of the return we've had year to date, they're still really strong. Stocks are still, that is the S&P 500, is still delivering positive earnings growth. Earnings have slowed down a bit. They're not growing nearly as much, but they're still delivering quarter after quarter additional earnings growth. From a PE perspective, in terms of long-term average, stocks are still cheap. An average large cap stock is trading at about a 25% discount to long-term average. Growth-oriented companies, technology, large consumer growth-oriented firms are trading at almost a 35% discount. And we see reasonable valuations not only in large cap but mid cap as well as small cap. These valuations range from as low as about 10% to as much as 35%. But all of these are discounts off of long-term historic average. One last thing I want to mention before we move on to the agenda and our first point, which is the U.S. expansion. Many of you have noticed, gee, it just looks like we're not doing anything. The markets seem to be fairly flat. We haven't seen much movement. And the reason for that is, in spite of where we are today or where we were as of June 30th, we're still beneath where the all-time peak was. S&P peaked on October 9th, 2007, coming up on the 5th year at 1565. And as of June 30th, the S&P was 1362. That's about a 16.9% discount from where the high water mark was. Or another way of looking at that is this is the return needed to reach the peak. And if we were hoping to do that in a 12-month period, we would need about 16.9%. So from a valuation point of view, we're not quite back to where the indices were 5 years ago. And that's one of the reasons that we feel like the market's done nothing over that period of time. Let's talk about the first point that we wanted to share some information on, and that is the U.S. expansion. The U.S. expansion certainly has slowed, but it doesn't look like it has stalled. When we look at the expansion for the first quarter of the year, GDP was at 1.9%. That's certainly anemic compared to the long-term average. We're at a point now, though, that we've recovered $850 billion of output compared with the nearly $700 billion of output lost. And that's certainly important. I think there's two reasons for the anemic growth. One certainly is we've got this fiscal cliff issue. That is to say, the government has a fiscal drag. They're trying to reduce services, reduce deficit, and at the same time, banks are very reluctant to lend money. And as a result, there's very little growth impetus. Now that might change as we move into the election, but right now it really causes a very slow, anemic growth pattern. When we look at various sectors of the market and certainly look at cyclical sectors, what we're seeing in almost every single case, these sectors are still trading below trend. Vehicles are close to, but not above the 14 million level, and they're certainly still below the average of 15.1 over the last 10 years. Housing, same story. Manufacturing and other manufacturing inventories. The fact that we're so far beneath these particular levels also gives some credence to the argument that, look, we're probably not going to see a big crash in our economy or a significant slowdown. And the reason is, to have a significant slowdown or historical slowdowns have usually been as a result of a significant decrease in housing, auto, business equipment, and inventory activity. The fact that these activities really haven't gotten out of the gate yet would indicate that there's very little downside risk in losing momentum or losing output from these areas because we really don't have much. One point I did want to make is housing is beginning to show some improvement in price, and we'll talk about that in just a moment. Oil is an area that can be viewed as a tax, and oil's been bouncing around all over the place, as is witnessed by this graph here. Effectively, we had a rise in oil for the first quarter, a fall in oil prices for the second quarter, and now since June, prices have kind of creeped back a bit. The prices that we see today in oil are rising effectively because of the seasonal driving vacation period. The expectation is those prices will come down, and when they do, that's like a reduction in tax. That's significantly an increase in consumer discretionary spending. We think we will see that for a couple of reasons. One, we're generally seeing a little bit of a slowdown in terms of China. Europe's in a little bit of a recession. And also, U.S. production has increased significantly. Those three components will probably drive oil prices down into the fall and winter, and we'll see that as an increase in discretionary spending. Let's talk for a minute about housing. You know, when you talk about housing and you look at the housing industry, there are a number of different numbers, a number of different metrics to look at. We can talk about home sales. We can talk about housing starts. We can talk about mortgage interest payments. The most important matrix is price. And price is beginning to show some improvement. We're seeing it in terms of purchase only, we're seeing it in terms of purchase of existing homes, and we're seeing it in terms of the Case-Shiller 20-city index. That's very, very important because pricing helps to drive further economic growth. It is still true today that the bulk of one's net worth is tied up in home equity. We may not see it ourselves, but across the nation that's very much true. And today the average American owns 40% of their home. They have about a 40% equity position. If housing prices increased simply 10% over the next couple of years, that would represent an increase in home equity component of about 25%. So we'd go from 40% to 65% ownership. Boy, does that change one's opinion? Does that maybe cause people to feel a bit wealthier? The wealth effect translates into consumer confidence, and that makes a huge, huge difference. In fact, it's so powerful that if we experience that 10% improvement in pricing, but it took 4 years to accomplish, that 10% increase in pricing would effectively increase GDP growth by 0.5% a year. So pricing is very important. We're beginning to see that. Another thing that's encouraging, that's driving pricing, is this matrix here. When you look at rental pricing versus home mortgage pricing for comparable square footage, there's no comparison. It's far cheaper to effectively own a home than it is to rent. And what that's doing is driving new first-time home owners into the marketplace. The other component that's improving pricing is inventory. And inventories are coming down because banks are still not lending or very stingy in terms of lending. We have very, very little housing starts. In fact, we have 700 housing starts, 700,000 housing starts per year. The mean normal, basically scrappage rate, is about 1.5 million units. So that move over a 4-year period can dramatically improve GDP. And because nobody's building, we're seeing what units are available in terms of inventory diminishing. And as a result, pricing is going up. That's encouraging. Let's talk about fiscal cliff. That's certainly been in the news. It's a concern that most folks have. We certainly feel, unfortunately, it's going to be in the news for quite some time. It'll be partly part of the political football. We don't think a lot will happen between now and the election. After the election, there will probably be some degree of compromise. And I think that's important for a couple of reasons. We've got to fix the degree to which the deficit is getting spent down. I know it sounds strange. We want to reduce the deficit and reduce the size of the deficit. But if we reduce it too quickly, that may slow the economy or choke growth off. To give you an idea, back in 2009, and you can kind of see that here, the deficit as a percentage of GDP was about 10.2%. It then dropped to about 9% in 2010. In 2011, it became 8.9%. We're now tracking at about 7.6%. And by 2013, or actually 2014, that number is expected to be somewhere around 3.8 or 4%. This move here could really, depending on how it's done, could really kind of choke off some degree of growth. So what we want to do is, instead of that trend, which effectively is this gray bar here. So this is where you see 3.8 and further reduction, and that reduction is coming from an increase in tax revenues because of the Bush tax cut being eliminated. The idea is to create some compromise that may slow this up a bit and continue with market growth. So slowing this up over the next 10 years as opposed to really killing this from a contraction in government, contraction in revenue, and higher taxes. Both of those things are a huge double whammy. So as a result, we certainly expect to see some degree of government compromise. Both Republicans and Democrats have a significant vested interest in coming up with something. When we look at these numbers here, these purple numbers, and here's why. These purple numbers here represent non-defense discretionary spending. These are the things that the Democrats have compromised on that need to be cut. Effectively, if we get to the point where we're being forced to cut those based on prior agreements, that represents just about everything that the Democrats have struggled for the last 10 years. All the gimmies they've gotten get eliminated. And as a result, it gives them impetus to come up with some degree of compromise. Conversely, the Republicans need to submit to the president a budget that he has the ability to sign. If they don't, then effectively the Republicans are going to be blamed for increase in payroll tax and some of the other increases that effectively are going to come by way of the fact that we've gotten this logjam. So on both sides, there is some degree of compromise. I don't think anything is going to happen right now. I think Washington is going to look at where we wind up in terms of the election, and then we'll see where we are. But I certainly expect that we will see some degree of compromise and avoid fiscal cliff. In fact, John Boehner has already said so much. Unfortunately, the one thing that we probably will see is some degree of tax increase. Taxes for the very wealthy could increase substantially. If you look at the chart here, you'll notice wage income. Highest rate right now, 37.9. That goes to 43.4. Dividends go from 15 to 43.4. 43.4 is effectively the high tax rate, plus there's an additional 3.8% as well that's built in for Obamacare, plus the reestablishment of the rest of the Bush tax cuts. We think the likelihood is you'll see something that's going to look a bit like this, but both capital gains as well as dividends will probably be compromised to something a bit less. Payroll taxes will increase again to normalcy. And I think there's a big reason for compromise as well, because as it is right now, if the Bush tax cuts phase out, every American loses the payroll tax perk they've got, and low, medium, as well as high income all get shifted to a new tax rate that effectively drives up the effective rate, not just at the high levels, but at all levels. So this slide alone would indicate to me that, for many of my clients, we'll need to have some degree of conversation as we move into the end of the year, look at portfolios, especially taxable portfolios, see if there are things that we can do from the standpoint of harvesting capital gains, especially if you're in a bracket that's likely to move up significantly. And all of that will be done certainly toward the end of the year, probably after the election. Let's talk about the European debt crisis for a minute. Europe is ugly. There's no other way about it. The headline news is pathetic. We've got the Greek problem. We've got the election in France, Spain asking for and receiving recovery and rescue aid. All of these things certainly are playing out in the news. The likelihood is there won't be a quick fix, and we're going to continue to see continual lingering problems with respect to Europe. As this chart shows, the x-axis is debt to GDP ratio. The greater we move out here and the larger the size indicates the greater amount of debt to GDP. And then this is real GDP growth. The bad thing about this slide is simply the fact that those countries collectively that tend to have the highest debt to GDP ratios also, to a large degree, have the slowest GDP growth rates. And bottom line, you can't fix the debt issue, you can't fix the deficit in a recession. So the idea is they've got to create some kind of stimulus program to get growth rates back so they can then deal with the structural problems that Europe has. And that, unfortunately, is going to take a bit of time. When we talk about Europe and we talk about valuations, we're talking about valuations on individual stocks, not the economy. You nor I invest in the European economy. We invest in funds or exchange-traded funds that own individual companies within that economy. And from that point of view, Europe looks cheap. This chart here represents a couple of different data points. The brown line that you see with respect to each country represents a 10-year average valuation matrix. It averages effectively PE, price to sales, price to book, debt to equity, a number of different valuation data points over a 10-year period. And that's the average valuation. The blue diamond represents where the valuation is today, and the gray bar indicates one standard deviation. So what we're seeing in the case of France, valuations today significantly below historic, outside of one standard deviation move. Canada, outside of one standard deviation move. Switzerland, not quite as much of a value. United States is better priced. It's not quite as cheap. There's better growth there. But the world as a whole, as well as the EFI, are all relatively inexpensive. Australia as well. So when we look at Europe, lousy headlines, already reflected in stock price to a large degree, and compelling valuations and relatively high dividends. Dividend yield in most countries is 3, 4, in some cases 5%. Pretty compelling. Emerging markets are slowing down. Their growth rates across the board are much slower today than they were, say, a year or so ago. Not surprising. As we can see here, when you look at the individual companies, the gray bars represent the last 4 quarters up through and including the first quarter of the year. And the blue bars represent forecasts. Now, although we've completed the second quarter of the year, they haven't really posted GDP growth yet, and that's always a lagging data point. But you can see almost to a man, we've had some degree of degradation in terms of GDP over the last couple of quarters. We're now beginning to see, in some cases, that beginning to pick up again. South Africa, Brazil, Korea is expected to pick up toward the end of the year. India is expected to pick up this quarter. But generally, as a group, they're lower today than they used to be. U.S., still pretty steady. We're expecting to see better growth the next couple of quarters, and then growth rates similar to where we are today. We're not looking to see a recession. We're not dipping into negative returns. Valuations in emerging markets, again, very compelling for the same reason, same matrix. China, fairly cheap. Russia, fairly cheap. But countries like Korea, Mexico, kind of expensive, a bit pricey. From a valuation point of view, in terms of forward PE, very compelling. As far as valuations domestically, things look pretty good. The U.S. market, and by the way, what this is simply a forecast of adjusted corporate earnings. That's where the earnings come from, with the current market value of the broad-based equity market. So it's a legitimate price to earnings comparison. And today we're priced at 12.1, not as cheap as it's ever been, but still very inexpensive, as cheap as it's been in a decade or more, and significantly below the long-term average, which is 13.7. Markets are certainly inexpensive. I love this graph, or this chart. It's a scattergram of PE, price earnings, to equity return. And what it says is valuations are extremely meaningful for longer term periods of time, like a 5-year period. Valuations, or when you buy in, or what you expect to get after a year, are much less meaningful in a 1-year period. But over the long term, it certainly is meaningful. So how do you read this thing? The x-axis represents PE, 10 times earnings, 15 times earnings, 20 times earnings, so on. The y-axis shows total return over a 5-year period, and these returns are annualized. So these are total annual returns. The dotted line that's running through the x-axis represents the current PE for the market. Where it intersects, about here, would suggest a longer-term return of somewhere in the order of 15+% annualized 5-year average. Now, there are outliers, but you can see in terms of best fit here, kind of regressing these numbers to a best fit, that looks reasonably attractive. On a 1-year basis, very difficult to establish any kind of correlation here at all. What this also says is that as you buy stocks that are pricey, when you buy, as an example, PEs that are trading at 20 or more, the return expectation is very low. Now let's look at this from a real-life scenario. Consider where we are today. And I had this conversation with a number of clients that were looking at lump sum. And by the way, we had, on a percentage basis, very few people that we recommended the lump sum to. We wanted to see a large degree of margin for error in terms of the calculation. But of those that we did suggest it made sense, we use this analogy. You know, we're coming off of a 10-year period where the market has averaged 2.8% compared to 9.8, which is long-term historic average. And we're concerned about the future, and we're concerned about return. But where PEs are today, as we see here, the expectation going forward is very strong. Yet, to us, it's a leap of faith. Conversely, if this were 1999 and we're coming off of a decade where the returns were 19 or 20% a year, where the last 5 years the S&P averaged 23% a year, we would sort of feel like that was expected, that was average, and we'd feel much more confident investing in that kind of a scenario. But as this chart shows us, when we invest in a scenario like that, where P's are dramatically higher than where they are currently, the expectation is the returns that we get are probably going to be significantly less than the returns that we would generally expect to get by buying in at a lower PE. High returns over an extended period of time are very difficult to continue. Low returns over a significant period of time, at some point, probably regress toward the mean. Can't tell you it's going to happen this year or next year, but the expectation is they do. So from an investment point of view, investing now going forward, in spite of all the headline news, is probably a little bit less of a leap of faith than most of us believe. Also on the valuation theme, long-term bonds, 10-year Treasury bonds, ridiculously low, nearly as low as they've ever been. In fact, at 1.67%, if we were to net the inflation effect, the real rate of return is actually about a negative 0.5%. Effectively, the returns on the market net of inflation below zero. And when you look at this, and you look at this as a 30-year bull market in bonds, the expectation is at some point in time, bonds probably won't do very well. So our view of long-term interest rates and long-term bonds are generally pretty weak. One of the bright spots in terms of bonds still remains high yield. The spread or the yield or the interest rate that we're getting on high yield bonds compared to treasuries, fairly robust. The spread is somewhere around 6.6%. Historic default rate 4, current default rate 2. The environment is healthy, bonds are healthy, yield is very strong. When you're looking at a yield spread of 6 or so, what that tells me is that there's a lot of coverage for error. If interest rates started going up, treasuries would lose value. The spread here would probably narrow, and we would still have real return or nominal returns that would probably be higher than treasuries, and probably real returns that could still be positive. And as you can see here, the spreads today are nearly as wide as they've ever been. In the panic, they were certainly a bit wider, but historically, over time, they're about as wide as we've ever seen them. And that's generally a good time to own those kinds of bonds. Let's talk about balance. One of the big mistakes a lot of us make is chasing performance. Gee, stocks did well, let's get more stock. Bonds did well, let's get more bonds. And usually that's sort of like closing the barn door after the animals have all left. Balance is really important. It's especially important in this kind of an environment. Again, let's go back to the market. Market's recovered substantially from the low water mark. Hasn't been a straight line. And there have been plenty of opportunities to panic, get out, change focus. And when we do that, generally we lose return, we certainly lose opportunity cost. When we look at what the public has done, though, because the market has been so choppy, remember the market peaked in 2007. Effectively, since 2007, every single year, those red numbers there indicate a net redemption out of equities. There has been more money every year moving out of equities than going into equities. Prior to the sell-off in the market, we had a net inflow. Then at the market bottom of 2002, which was the dot-com bubble, we had an outflow. And where is that money going? For the most part, it's going into taxable bonds. Now, why is that? It's probably because of the inherent volatility in the market and the general fear that the public has as well. Part of that is headline news. People are worried about falling off a cliff. They're getting out of stocks. and they're chasing bonds which have at least held value. Now remember the slide from a couple of moments ago when I talked about bond yields. Let me try to bring that back up. Yields are as low as they are. People buying bonds today have no hope of a positive return over the next 10 years unless you buy individual bonds and hold them till maturity. If you buy a bond fund, an ETF, what have you, the expectation is the return you get probably will not be what you expect it to be, and certainly not what the performance was at the time that you bought the instrument. Real return is 0 or less, and for every 1 percentage point rise in interest rates, a 10-year bond loses approximately 10% of its value. Consider the fact that bonds are 3.5% cheaper today than they were just 5 years ago, would suggest that there's a lot of risk built into the equation. Yet, the public is buying bonds and getting out of stocks. That would certainly imply to me that stocks generally are a whole lot cheaper from a valuation point of view than bonds, and probably offer a more compelling valuation and promise of expected return going forward. We can see the difference between flows of stocks into bonds. This is net outflow of stocks versus money going in stocks. This is stocks versus bonds. It's overwhelming. Public generally does the wrong thing at the wrong time. So because of that, taking a balanced approach really makes the most sense. A balanced approach effectively won't hit home runs, but it also won't lose significant amounts of money. A balanced fund would have lost 24%, let's say, in 2008, but it wouldn't have lost 50 or 27 or 40 as the S&P did. When we look at the returns of various asset classes any one given year, let's look at, as an example, 2011. REITs or real estate did the best, 8.3. Emerging markets did the worst at minus 18.2. The S&P was basically flat at about 2. That was all dividend. And an asset allocation fund would have just lost a little bit of money. Now, year to date, the S&P's up 9.5, and that asset allocation fund is up 5. When I say asset allocation fund, I mean a globally diversified portfolio. When we look at cumulative 10-year average, that allocation fund was up 6.4, whereas the S&P was the worst performing category at just over 2.9. Reason? You don't get your head handed to you. So in a good year, you're not getting the same return, you're not running with the market, you're growing, portfolio is growing, and in a bad year, you're not digging such a big hole that it takes 5 years to get out of. And as a result, that's kind of the magic of compounding. And you'll see in past times, a number of times where the return from an allocation fund significantly performed better than the S&P. So having a balanced, diversified portfolio certainly makes the most sense. And that's generally what we try to adhere to. What I'd like to do is open up to questions, and while I'm waiting to see if there are any questions, I'll suggest a couple of other things. One, it is summertime, and because it's summertime, I just want to again point out the fact that the market is prone to pullbacks. I love this chart. The gray bars indicate the return on the S&P 500 in any given year. So for example, the S&P was 0 in 2011, up about 13 in 2010, up 23 in 2009, and down about 38 in 2008. The purple dot underneath represents the maximum drawdown that the market experienced during that calendar year. So as an example, in 2013, the market for the full year was up 13. However, during the summer, from peak to trough, the market dropped 16. Already in 2011, the market finished flat on the year, but during the summer, it experienced a 19% drawdown from peak to trough. So when you see these hiccups or pullbacks, especially seasonal pullbacks like the summer, just remember that they're very common. And by the way, the average pullback in the market any year, whether the market's up, down, or sideways, is about 14.5%. From a seasonality point of view, the market kind of looks like this. The best 6 months is usually the period of November through April, covers the last 2 months of the year, and then moves right into the first quarter of the year and beyond. The worst 6 months, the old sell in May and go away, is the period of time from May 1st through November 1st. And generally, that's the period where you see some degree of pullback during the summer, although not always. And then September and October, which are included in that period, are also a bit dicey. This shows the compounded effect of investing in the best versus the worst period of time, and it's very compelling. And those values, I think, are updated through 2011. Last thing I wanted to mention is simply, hey, if we could be of any help to anybody, friends, family, associates, colleagues, we do offer a second opinion. We can look over what they're doing now, develop a proposal, talk about the proposal from the standpoint of what it looks like in terms of transparency, what it looks like in terms of cost, what it looks like in terms of liquidity, and generally share with them how we manage, how we build portfolios. So if we can ever be of any help, please let us know. We certainly would be most appreciative. With that, let me thank you, and I just want to make sure that we all have time to look at the definitions, risks, and disclosures. My compliance and legal department will certainly thank you. Have a great summer. We will talk to you after the end of the quarter. Thanks so much. Have a great evening. Good night.